Shift Focus, and joining us right now from the Infrastructure Investor Forum sidelines, we've got on board with us Dipen Sheth, Head of Institutional Research at HDFC Securities. Dipen, hi, good morning. Tell us what has been the chatter at the Infrastructure Forum. What have been the key takeaways from day one?
So let me walk you through what the event essentially was. We invited 15 companies to attend the Infrastructure Forum, and so they ranged from 1,1700 crores market cap all the way up to about 13,000 crores. Plus we had 4 unlisted companies, people like KCC or Govt or Monte Carlo and GR Infra. These are unlisted companies in the space, and they brought their own unique flavor in terms of the insights that they brought from the ground for investors in the listed space to learn from. Our rough estimates suggest that these 15 companies, between them, had close to about 2/3 of the ex-L&T infra order book of the country. It was in one place under one roof yesterday at our forum. Their revenues range from under 1,000 crores to over 7,000 crores. We had road builders, we had HAM bidders, we had metro railway contractors, we had irrigation system and canal makers, we had mining contractors, urban infra specialists, building construction companies, etc. So the entire spectrum of infrastructure makers was here. And I think it gave a unique opportunity for institutional investors to figure out what's happening in the infra space.
So within infrastructure then, considering it's such a large gamut, Dipen, where is it that you're finding maximum value and maximum wealth creation for investors? What are the pockets they could still look at?
So it's obvious to say that roads is where all the action is, but I don't think we should get carried away that way. So roads and now increasingly urban infra as the metro tenders mature in various cities. So what came out really from our interactions with all these companies is that India is actually on the edge of what I would describe as a super cycle of building out infrastructure. Now, it's not that we never needed infrastructure or that we weren't conscious about it or that infra wasn't a big talking point at almost every national forum or event. It's just that this is now completely policy driven, and it's aimed at boosting productivity across a range of sectors when the infrastructure is available, not to mention better quality of life. And the reason it is happening is that the government has removed a whole lot of hurdles and burdens on infrastructure developers, which used to bog down their performance and ultimately result in stressed balance sheets and also result in not delivering the infrastructure. So I don't think we should confine ourselves to just, let's say, roads or railways or ports or airports or urban infra. I think a whole lot of these players who attended yesterday, while many of them have begun actually as subcontractors for larger road builders or infra asset owners in the past, many of these guys have now diversified their business mix across a wide variety of spaces. And maybe we shouldn't look for a particular flavor. All that we need to look for is whether their order books are growing, whether they are good at execution, whether they can hold on to their margin guidance, and whether their cash flows justify the kind of valuations that some of them are trading for.
I'm going to change gears and talk about the NASSCOM guidance. TCS is excited ahead of the NASSCOM guidance. Do you think today NASSCOM is going to strike the right chords? Maybe talk about better days ahead rather than acknowledging the problems of disruption in US tech spend?
So Nikunj, you will remember me as the guy who's been holding a flag for IT ever since it ran into a whole lot of worries. The big picture on IT is still murky. I will say that if you look at a 2, 5 or longer year period, then Indian IT, the services part of the business, is certainly going through a disruption. However, you need to temper this with the fact that the IT industry in India is run by some of its smartest people, and that we have consistently and successfully competed against the best minds globally in this sector. So to repose faith in this sector when it goes through difficulty is actually something that should naturally come to value investors, and that's what has played out now for the last year or so. And after December, if you will remember, Coincidentally, that was the time when we had our mid-cap IT forum. But that's a small coincidence, I would say. But post December, the kind of run-up that you're seeing in IT stocks tells you that a little bit of sector churn is happening. The skeptic in me says that we really don't need to worry about NASSCOM's guidance. We really need to track US GDP growth. We really need to track US corporate spending and their appetite to spend on technology to be constructive on IT, and much of that has played out. What's important in NASSCOM's guidance here on is the noises that they make on the disruptive part and how Indian IT is positioned to tackle that disruption. I still believe that a lot of India's IT service firms are not fully geared, but some of them have started making the first few moves, whether it's in terms of automation, whether it's in terms of digitization of their businesses, whether it's in terms of moving up utilization from the early 70s to the mid 80s now, and whether it's in terms of taking up fixed price contracts and embedding more and more non-linearity in their services. In fact, some of them have actually moved towards product development, and these are some of the smaller firms. So I think Indian IT is run by smart people. They've got a little bit of a whammy over the last couple of years, and they are responding, if not magnificently, at least admirably well in the circumstances. I think as the dollar strengthens and as some of these IT firms get back their mojo, we are actually looking at a sweet spot coming up for IT. So I'm not just going to get completely swayed by whatever NASSCOM says. I will look for signals on future evolution rather than a percentage guidance today.
Will you be a contra buyer in PSU banks? Because Dipen, we all know the bad news. It's out in the open. And in markets, we both know that it is not important to react to the news, but try and figure out how much of the good news or bad news is in the price.
I take your point here. There is a prima facie case for perhaps trying and becoming value investors in PSU banks. But however, let me temper that thought by saying very clearly that everything that is inherently good in the markets goes through a bad phase. However, not everybody who goes through a bad phase is inherently good. And I know I'm sounding a little confused here, but let me say this in explicit terms. And let's bring back the IT analogy here. We knew, you knew this, I knew this, and the market knew it, that IT firms are run by talented people. They have very clean cash flows. They have very high corporate governance standards, barring the occasional, blow up like Satyam. And they are inherently, competitively capable of facing up to competition from outside countries or from other firms. I'm not so sure whether you can say this about PSU banks. They are legacy businesses. They don't seem to be customer friendly. They are now going through a crisis, as it were, of perceived fall and cracks in corporate governance standards. And they run in a very, very tightly regulated industry with, I would say, not so great corporate governance problems cropping up from time to time, as we have seen in the NPA blowouts, as we've seen now in some of the blowouts at cases like PNB and so on, and their masters, which is the government of India essentially, don't seem to be too aligned towards shareholder value creation, unlike some of the private players or the NBFC players. Now, does it mean that PSU banks are a complete washout? Absolutely not. I think instances like SBI and BOB come to mind immediately. If you tell me the entire PSU pack is junk, I would say that's a complete exaggeration, and we shouldn't be looking at it that way. So both BOB and SBI are run by excellent managements, but they've gone through their hassles in life, their failures in life, and I think this is the time where we need to take a really hard look at whether PSU banks are really doing justice to their shareholders, and the best moves on this front will not come from their managements as much as they will come from the government, and I will wait for something really big to happen there before thumping the table on PSU banks.
What about pharma as a space, though, Dipen? Because, February is turning out to be a rather critical month. A lot of the US FDA pending inspections are currently on. But again, you're not really seeing that, a bout of clearance coming in from the regulator as such. And again, it's a very selective story when it comes to pharma. You can't really paint it with the same brush. much like IT is turning out to be. What would you do with some of the pharma names?
So I think that's an interesting question to raise. Aisha, the thing about pharma, the similarity with IT, if I can say this, is that pharma is also run by very highly educated, sharp and clever people. Some of the smartest minds in our country run pharma businesses. Pharma is also a sector where we've had reasonably good corporate governance. It's not that these are companies with very high return ratios or very clean cash flows, but yes, these companies have typically been run by managements which have exhibited great corporate governance in the past. And this is also an industry where a lot of the mumbo jumbo is not understood by, let alone the average retail investor, but by seasoned institutional investors as well. So if this industry has gone through a crisis of sorts, which has essentially depended or been founded on two legs. One is the almost continuous erosion in generic products in the US, in the lucrative US market, and two, the regulatory clampdowns that have played out over the last 2 or 3 years. I think there has been enough reason for investors to worry about this sector. That said, we are seeing the first signs of a comeback here, and the first signs of a long but solid bottom being formed. In terms of instances where companies have bounced back from regulatory clampdowns, I think Divi's and Cadila come to mind immediately. I think companies, the large guys like Sun Pharma and Dr. Reddy's are going through a sort of reinvention in their business models as they grapple with generic price erosion, as well as the regulatory troubles that they've gone through. I think it is time not to wait for the good news to come in, but to selectively place faith in many of these companies, based purely on the fact that they are run by clever people who can be depended upon to steer their companies out of a crisis. So definitely names like Lupin come to mind, names like Cadila, despite the slightly high valuations, do come to mind. And a couple of interesting picks in the mid-cap space will also matter, I guess. But maybe that's something you might want to leave for a later discussion.
From pharma, I'm tempted to talk about hospitals and none other than Fortis right now. What's the story, Dipen, besides the fact that, you know, it's tangible hospitals that are there for everyone to see, irrespective of what's going on with the management? These are takeover candidates. I mean, these are large capacity hospitals that Fortis owns.
And so hospitals is a very, very capital intensive sector, and the franchise gets built over years, and valuations can actually looking at the addressable opportunity for organized healthcare in India. Valuations have typically been, if not over the top, then at least extremely high. We do not have Fortis or any hospital stock under coverage for precisely this reason. However, what does seem to be playing out in Fortis right now is a serious corporate governance issue, and I will refrain from commenting on the details until I understand it fully. But I do believe that the sector is a sunrise sector, and if high corporate governance standards are adhered to, there is no reason why hospitals cannot generate wealth for equity shareholders. I think the corporate governance angle is why Fortis is going through a little bit of a, I won't say a little bit, but a major rethink on the part of investors right now, and we'll have to watch this space to really figure out what's happening.
Like quite the hot developing story now, with our Radhakishan Damani as well checking into the stock and picking up about 0.5%. But they've been great speaking with you. Thanks much for your thoughts on the markets and of course your infrastructure investor forum as well and the takeaways from there. For now.